Thank you. So if you take a notebook manufacturing, the sheet, the paper, what we need to make a notebook is direct material. The pin, the stapler pin. I'm not asking about the stapler. I'm talking about the pin or the paste or any kind of other material which is used to bind that papers into a notebook can be an indirect material. Without a stapler pin, you can make a notebook. You can just stitch all the papers together and you can just bring a notebook. Or without that thread, you can make a notebook by just stapling all the papers together. Without one wrapper, you can use another wrapper to make a notebook. So all these things are called as indirect material, but the paper, the ruled paper or unruled paper, the sheet is called as direct material. Okay. Similarly, labor cost, direct and indirect. To convert the paper into a notebook, for one notebook, how much you are paying, that is called labor, direct labor cost. Indirect labor means there are five laborers are working in your manufacturing unit, but there is only one supervisor. The salary payable to the supervisor cannot be attributed to a single notebook production. Even without the supervisor, sometimes the manufacturing will go on. He is not directly involving in conversion of raw material into finished goods. So such labor cost is called as indirect cost. But one who is converting the paper into notebook, for him you are paying some money. That money is called as direct labor cost. So I hope you are understanding. Next, expenses cost. Any expenses that can be directly attributed to the production is called as direct expense. Any expense which cannot be directly attributed to the production of unit is called indirect expense. Okay, rent payable for the building where your manufacturing is going on is an indirect expense. Rent. Okay, suppose you are spending 1 rupee for one notebook to just get a printing on the wrapper. You are having, suppose your university is ordering some notebook on the first page wrapper, we need that university name to be printed. For that, you are outsourcing that work. You are a manufacturer of notebook, you don't have a printing machine. You are outsourcing that printing on the first page, on the wrapper page from outside. For one notebook, they are charging 1 rupee to print. That 1 rupee is called as direct expense. Printing on the first page, wrapper page. That's called direct expense. And then other expenses, transport or room rent or any godown rent, all these things are called as indirect expenses. Per unit, if you're able to calculate, per unit, if you're able to apportion or allot or any kind of relating to the per unit, that is called direct. But you are not able to clearly find how much is 1 unit cost, then it is called indirect expense. So all indirect expenses, we can call them as overheads in accounting. All indirect, we call it as overhead. Overheads are nothing but over and above the heads. What do we mean by over and above the heads? There are 3 heads: direct material, direct labor, direct expenses. Apart from these 3, any other things are there to incur, spend to produce an article or a service. That expenditure is called as indirect, or I can call it as overheads. There are 4 types of overheads available in a company, depending upon the place where it is incurred: production overheads, administrative overheads, selling overheads, and distribution overheads. Production overheads, otherwise called as work overheads, are nothing but those indirect expenses incurred in the manufacturing process, incurred in the factory. Okay. If you incur any indirect expenses in the office, that expenditures are called as, that overheads are called as office overheads or admin overheads. And then during the process of selling your output, if you spend any indirect expenses, such indirect expenses can be called as selling and selling overheads. Okay, while delivering the goods to the customer place, If there are any indirect expenses incurred, such expenses are called as distribution overheads. So all indirect expenses are called as distribution, overheads. All indirect expenses are called as overheads. Okay, look at this. We have to prepare a cost sheet before you finalize the price of a particular product. We have to prepare a cost sheet. What is cost sheet? Cost sheet is nothing but a statement which just accumulates all the cost of production of a product or a service in a sequential manner in a format. I repeat again, cost sheet is nothing but a statement which helps us to estimate the cost of production of a product or service by having a breakup in different stages. Okay, look at these highlighted sentences here. Prime cost is nothing but direct material plus direct labor plus direct expenses. These three things we add together, we'll get it prime cost, prime, important, prime cost, major cost. Then if you add with prime cost, the factory overheads. I know by this time you may be knowing what is factory overheads. Anyone can tell me the example for factory overheads? What is factory overheads? I told you, any indirect expenses that are incurred in the manufacturing process or that are incurred in the factory. Any example for factory overheads? Anybody?
Steel.
Security.
Yes, sir.
Managing security.
Managing security. What is managing security?
Like each factory will have a security team. So the expenses incurred for the security, like their salaries, wages.
Salary paid to securities of the factory.
Yeah.
Okay. Done. Anything else? Any other?
The raw materials, steel.
Sorry?
Like steel or anything. For example, for cutting or chopping wood, the machinery for using the, chopping wood, etc.
I'm not getting. You're telling about raw material. Raw material is a direct cost. No, direct material.
Yeah. No, so the machinery which is used in the factory for chopping raw material.
Okay. Machinery, but machinery is not just a cost. No, machinery is a fixed asset. Okay, you can say the power used by the machinery, the cost of power used by the machinery, or the depreciation of the machinery. You are telling there is a machinery which is in the production process, or cutting or some kind of ancillary work that machine is doing to help the main production, or the production itself is done in that machine, no problem. But how do we bring that cost? How do we record that cost? It is nothing but depreciation of the machine or power consumed by that machine. These are all indirect costs which are incurred in factory. Any other cost? Yeah. Sorry. Somebody is trying to speak. I don't know. I could not get
maintenance cost.
Factory maintenance expenses. Factory maintenance expenses is another example for factory overheads. Yeah. Anything else? Factory rent, factory manager salary, factory machinery depreciation, factory insurance. Sorry.
To the change and it's a madam says
Your voice is breaking, madam. Can you type in? Not getting you. I'm so sorry, we are not able to get you. You can type in, otherwise check your connection. Okay, no problem. So any expenditure which are indirect in nature that are occurred in factory or in the process of production, that's called factory overheads. Okay, so if you add those expenses with prime cost, you will get factory cost. Okay.
The only negative then only positive.
Sorry,
Fine line.
are you talking to us or is it
No, they are not talking here, sir.
You have to mute her actually.
one second?
దాని తర్వాత చేంజెస్ అయింది కదా సార్ ఇది చెప్పారు కదా
I think that's disturbance. Okay, so after you add the factory overheads with prime cost, you will get factory cost. Factory cost. Okay, factory cost is nothing but the total of prime cost and factory overheads. Okay, then after you find out factory cost, you have to add all those indirect expenses that are incurred in office and administrative process. Okay, so if you add office and administrative overheads with the factory cost, we call that as cost of production. Cost of production. What is the example for administrative cost? Administrative overheads: office rent, office manager salary, office furniture depreciation, any indirect costs which are related to administration, office. Okay, then if you add office and administrative overheads along with factory cost, you will get the cost of production. Okay,
This labor cost also will come under administrative cost, sir.
sorry,
Labor employee salary, labor cost, that and all.
employee?
Yeah, employee salary or laborers.
Which
labor
employee?
salary. Or working in the factory.
Working in the factory is called factory cost, I told you, no?
Administrative overheads, it will not come under that. The salaries under.
What is office and what is factory? If we are dividing the place of work into two, one is office, another one is administration. Office and administration together, and then factory separately.
Okay.
If you pay any labor cost for converting the raw material into finished goods, that is not an overhead at all. That is a direct expense. Please understand,
Okay.
expense are being classified into two. One is direct, another one is indirect. What is direct? Any expenditure which can be directly apportioned to or which can be directly connected to the cost of production of one unit. That is called direct expenditure. Say for example, to manufacture one notebook, I need 90 pages or 100 pages. Assume the writing notebook. To make one notebook, I need 100 pages. The cost of buying that 100 page is a direct material cost. Okay, and I'm giving that material to one person and he is going to make that as a notebook. I am paying him 5 rupees. To make one notebook, he is working in my factory. By getting 5 rupees, he converts the raw material of sheet or paper into a notebook. For that, I'm giving him 5 rupees. That 5 rupees is direct labor. Direct labor. Like him, there are 100 members are there in my company. To supervise all these people, I appointed some another 5 members. They don't work for manufacturing. They just supervise the manufacturing. So the money paid to the supervisor who is in the factory to supervise all my laborers is called indirect cost. Since he is in factory, his salary will come under factory overheads. Salary payable to supervisor, salary paid to factory manager, salary paid to factory security staff, salary paid to factory accountant or factory assistant or whatever it is. All these people are there in factory. Because of them, the production is going on smoothly. But without them also production will happen. They are not directly involving in the production process. I'm not paying them per unit some amount to manufacture. They are just there to supervise the entire laborers, all laborers. So for those people, if I pay anything, that is called indirect. So direct and indirect we classify already. Okay. So any indirect expenses that are happening in factory, that is called factory overheads. Any indirect expenses that are happening in office is called as office and admin overheads. Any indirect expenses, if I am spending in the process of marketing, selling, delivering my product to my customer, then it is called selling and distribution overheads. Is it clear, sir, now? Yes? Anybody? Somebody ask a question, no?
Yes, sir.
Am I audible?
Clear,
Yeah,
clear
yes,
now.
yes,
Yeah,
yes.
yeah, clear.
So any example for administrative overheads now? Office rent is an example for admin overheads. Office salary, office insurance, office furniture depreciation. All these things are example for admin overheads or office overheads. Okay. So after you find out the cost of production, if you add the selling and distribution overheads, you will get cost of sales. On cost of sales, you will add some amount. That amount is that the result is going to be the selling price. Please understand. Selling price is equal to cost of sales plus profit. What is cost of sales? Cost of sales is nothing but cost of production plus selling and distribution overheads. Any example for selling and distribution overheads? Delivery van charges. Suppose you are giving home delivery. For that you are having some vehicle for which you are spending some money. That amount is called as delivery van charges. Warehouse charges. Warehouse. Salesman commission. Bad debts. Okay. So these are all the discount. These are all the example for selling and distribution overheads. So this is, if you write this in a statement form, that becomes a cost sheet. If you write it this in a statement form, direct material, another next one, direct labor plus direct expense. Like that, if you write, that becomes a statement of cost. Look at this, this is a cost sheet. Okay, direct material. How do I calculate direct material? Direct material consumed is nothing but opening stock of raw material plus purchase of raw material minus closing stock of raw material, or plus any incidental charges to purchase. Any incidental charge. What is incidental charge? Commission paid on purchase of raw material or transportation charge paid on raw material purchase. All those things are called as incidental charges. But anyhow, opening stock plus purchase, okay, minus closing stock of raw material is equal to cost of material consumed or cost of direct material. Okay, look at this side column. This is the total amount. Total amount. This is for per unit. Suppose the direct material cost, this value is equal to 10,000. To produce 1,000 unit, you are spending the cost of material for 10,000. Then what is for per unit? Okay, total cost divided by number of units produced is equal to cost per unit. In my example, if my raw material consumed is equal to direct material is equal to 10,000, I am producing 1,000 unit. Then what is the cost per unit? 10 rupee. Okay, 10,000 is the total cost of material. 1,000 unit only I am producing out of that value. So 1 unit cost of material is 10 rupee. Then you have to add the direct expenses. Okay, if the direct labor is there, direct labor also is added. Look at the direct labor, direct expense added together, we are getting prime cost. What is this outstanding and prepaid? If you are having any amount yet to be paid, or you paid any extra amount paid means you have to minus, amount yet to be paid means you have to add it. So the total is equal to prime cost. Okay, direct material, direct labor, direct expenses, all put together we call it as prime cost. Suppose this prime cost is 50,000, 50. How many units I am producing? In my example, I told you I am producing only 1,000 units. So 50,000 divided by 1,000, here it will be 50 rupees. Prime cost per unit will be 50 rupees. How did I get it? Prime cost in total divided by number of units produced. Okay. Then plus all factory overheads. All factory overheads one by one. We can write all the factory overheads. Okay. All possible factory overheads of that company. Then you are adding that factory overheads with your prime cost. You will get, that is called gross factory cost, minus closing work in progress. What is work in progress? Last year, you might have done the same process of production. At the end of the accounting year, there are some units which are not fully converted into finished goods. but they are not just a raw material. They have been taken and they have been processed. Okay, but it is not completed. So such value, closing stock of work in progress plus opening stock of work in progress. If you adjust this, you will get factory cost. Okay. So after factory cost, we have to add the admin and office overheads. Whatever is there in our factory, in our company, in our business. This is an
Professor, it
example.
should be.
Yes, sir.
Professor, if at
Yeah.
all there are many overheads you have been given here, na? So like all these are compulsory should be written in the statement, or like it depends upon the situation on the question what we get in the exam.
If your company is having that, you will be writing. Otherwise, we should be write it. Only from the situation you have to take it. Suppose your company is in the own office. You are having own office. Then office rent won't be there.
Okay.
Suppose you don't have any repairs in that particular year. Repairs and renewals won't be there. Okay.
Okay. So whatever given in the this particular pattern is like is the maximum. Whatever possibilities could be given in the exam. So that is what.
Specimen. This is a specimen, right?
Specimen. Okay. Okay. Thank you, Professor.
Okay. So you have to add all the admin overheads. You will get cost of production. If all the admin overheads added with the factory cost, this amount is there now. In this, from this amount or with this amount, you have to add the total of office overheads or admin overheads. Okay, you will get cost of production. Again, cost of production in total divided by number of units produced is equal to per unit cost of production. So after cost of production, we have to plus minus the opening stock and closing stock of finished goods. Okay. Last year you might have produced 1000 units, but you sold only 850. So 150 left out. That 150 is going to be added in the current year production. So total number of units available for sales will be 150 more than that of what you are producing in the current year. Current year we are producing only 1000 units, but last year 150 units are produced, not sold. So current year available unit for sale is 1150. So what is the value of that 150? So that we have to bring it here. Opening stock of finished goods value minus this year also we are estimating this many units we cannot sell it. Okay, so that is called closing stock of finished goods. That you minus the rest of the amount is called as cost of goods sold or cost of sales. Cost of goods sold. Cost of goods sold. Okay. Then you have to add the selling expenses, selling and distribution overheads. Any indirect expenses relating to sale, market are called as selling and distribution overheads. Example, advertisement, salesman salary, okay, free sample given, commission to salesman, okay, delivery van expenses, okay, delivery charges, everything. So put together, we add with that when we call cost of sales. Along with cost of goods sold, if you add all the selling and distribution overheads total, we get cost of sales. Okay. Now you are having the ready amount of cost of sales. Now the management will decide how much we have to fix as profit, or what is the price available in the market for this. One unit can be sold for 25 rupees, sir. Okay, 25. What is my cost of sales? My cost of sales is only 22. So 3 rupees is my profit. That is one way of calculating profit. Otherwise, I am the dictator in the market. My total cost of sales per unit is 23 rupees. I want to sell it for 30 rupees. So I will fix a profit of 7 rupees here. It depends upon the market. If it's a buyer market, then you cannot sell it more than 25 rupees. So you have to accept the profit is 2 rupees only. Otherwise, it's a seller market. You are only the leader in the market. You dictate to the markets. That time you can fix the reasonable profit out of your experience and the market condition. Then you can add this profit with the sales, cost of sales, you'll fix the selling price. Otherwise, other way around. Selling price is known in the market. From that, you minus the cost of sales per unit. Remaining is your profit per unit. So this is called cost sheet. Cost sheet. Any doubt in this? Direct material, direct labor, direct expense put together is called prime cost. Prime cost plus factory overheads, then admin overheads, then selling overhead. Any doubt in this statement of cost? This is called statement of cost or cost sheet. Can you move to the next one?
Yes,
Any
Professor.
reply? Yes.
Yeah.
Okay. So next one is marginal costing. Marginal costing. There are so many techniques available, tools and techniques available in cost accounting, but we are not discussing all those things. One is for ascertainment of cost, another one is for control over the cost. For ascertaining also we have a lot of techniques. Among them, one we discussed now, that is cost sheet. Depending upon the nature of industry, the method what we are going to use to ascertain the cost of a production differs. Now, just now what we discussed is useful for only those industry which is having a uniform costing. The products are identical in nature. 1,000 units, 2,000 units, all are identical. The customers are not specifying the design of the product. It is the industry, it is the manufacturer who decides the design of the product, and products are identical in nature. Suppose a tea cup, take an example, a tea cup, okay, plastic cup or paper cup or steel cup, whatever it is, tea cup manufacturing. That industry will apply a size, that's all. Sorry, the 200 ml cup. A cup which is made out of steel and it should be containing 200 ml of water or tea or milk, 200 ml capacity. If this is the specification, 1 lakh unit, 2 lakh unit, 1 crore cups you manufacture, all the cups will be identical in nature. If those industries are there, for such industries, we can apply the system, the method what we just discussed called cost sheet to identify or to ascertain the cost of a production, cost of a particular product. Some other industry, all industries are not like this, no? Some other industries, they will go by the customer specification. Simple example, construction industry, civil works. All the houses are not identical in nature. Same engineer, same architect, okay, same person may construct a lot of differences depending upon the customer's requirement. I may go with 1,000 square feet of piece of land and I will ask my architect to design a particular house. Another person will be 2,000 square feet. The size of the piece of land itself is different from each other. And the design, the model, material used, many things will be differing from one customer to another customer. Those kind of industry, we can't go with the costing by this method of cost sheet. There we have to go by specific job order costing, job costing. Each and every unit of building is a separate job. Just I'm giving an example and a basic idea. All those things are not there in our course. To decide the cost of production of a product, we use some methods depending upon the nature of the industry. Okay. Similarly, to control over the cost, to have a control over the cost, we have a lot of techniques. ABC costing, standard costing, variance analysis, like that we have so many. One among them is marginal costing. Please understand, to ascertain the cost also we have different methods. How do we select the method? Depending upon the nature of the industry. Suppose you are having a oil refinery, we can't go with this cost sheet. Oil refinery, okay, process costing. We have the output coming out from so many process 1, process 2, process 3. The output of process 1 will be the input for process 2. Oil refineries, okay, example. Textile industry is an example for process industry. So in that industry, we cannot apply just a cost sheet. We have to apply a different technique called process costing. That is the method to ascertain the cost. So we are not having all those things in our syllabus. Just I'm telling you, there are two objectives we decided. One is ascertainment of cost. In that we have a lot of methods to ascertain. depending upon the nature of industry. One of the methods is uniform costing. In uniform costing only, we have the cost sheet. Uniform costing. In that, we have a technique called cost sheet. Where we can apply this uniform costing method, the industry which is producing for stock, not for order. Specification will not be there. All units will be identical in nature. Those industry can very much apply the uniform costing method of ascertainment of cost. Okay, leave it. Come to the next one. Control over the cost. We have lot of techniques to have.
Sir,
Yes,
you're not able to see the PDF.
the PDF is closed. I'll show you another one. Yes.
Okay.
Yeah. Okay. I'm just moving on to the next aspect that is called marginal costing. Okay, for that I'm giving an explanation. I'm sharing that also. Yes. I think you are able to see the word file.
Yes, sir.
So marginal costing is one of such methods or techniques through which we can have a control over the cost. There are a lot of techniques available for us to have a control over the cost. Say, for example, ABC costing, standard costing, variance analysis, break-even analysis, marginal costing, etc., etc. So one among them is marginal costing. So one in ascertainment, one in controlling. We are studying in this particular course called accounting for managers. Okay, let us come to the marginal costing. It's very interesting technique in cost accounting, marginal costing. Actually, what we mean by marginal cost? Marginal means the extra cost which are added to the total cost of production. Suppose I have produced 100 units by spending 1000 rupees. I have produced 100 units by spending in total 1000 rupees. Now I'm going to produce one more unit. How? 101 unit. I'm going to produce one more unit. Now, what is the total cost? It is 1100 or 1020, whatever it is. The difference between total cost of production for 100 units and total cost of production for 101 units. That is called marginal cost. Marginal cost is nothing but the change in the total cost when you increase one more additional unit of production. One more additional unit of production. Okay, that is called marginal cost. Why do we use this, or where this is used, and how do we take this as a controlling technique, cost controlling technique? I'll explain to you. In this method, we classify the cost into three categories. Under marginal costing technique, we classify the cost into three categories. One is fixed cost. Another one is variable cost. Another one is semi-variable cost. Semi-variable cost. Variable, semi-variable, and fixed cost. We classify the cost into these three categories: fixed cost, variable cost, semi-variable cost. What is fixed cost? Anybody knows what is fixed cost? Have you heard about it? Fixed cost. Fixed cost, variable cost. Have you heard about it? Anybody? Any guess? Any guess about fixed cost? Is the screen visible to you? Class?
Yes. Yes, sir.
Yeah, okay. So any guesses from your side, what you can say for fixed cost? Don't confuse this one with the fixed price. Suppose you'll go to some of the shop, they will not have any negotiation or bargaining. They will just tell the fixed price. That is different. Now we are talking about from the manufacturing angle, from the manufacturing perspective. We have a lot of things to spend, right? Cost, I mean, material cost, labor cost, and then direct, expense cost. These three are there. Among these three, we are classifying them into fixed, variable, and semi-variable. Any example for fixed cost? Or any guesses?
Raw material
College
cost.
student will be there, no? Yes.
Raw material cost can we consider as fixed cost?
Raw material cost can be considered as a fixed cost. Okay. Anybody?
Variable.
So first of all, what is, any guess what is actually we refer as fixed cost? What's the characteristics of a fixed cost? Raw material cost is a fixed cost or variable cost?
It can be a fixed cost if we have a rate contract signed.
Sorry?
If there is a rate contract type,
Then
then
you are misunderstanding what is the meaning of fixed cost. You are not able to, I mean, what is fixed cost? First you have to decide that, then only you can tell whether raw material is a fixed cost or variable cost. What is fixed cost actually? What is the characteristics of a fixed cost? Anybody?
price remains fixed.
Sorry? That's what I told you. Don't confuse the thing with fixed price. Fixed price is different from fixed cost, what we refer here. Okay, let me tell anybody, final chance. Okay, any cost which does not vary, along with the level of output, or volume of output. Now look at your attendance, attendees list. How many are there in the class? Participant list you can see just quickly. How many are there? 36 are there, right? 36 are there. Now assume the university is paying me per hour some X amount. Per hour X amount they are paying me. Assume. Okay. Now only 36 students are attending the class. Suppose next class or previous class 60 students are attending. 60 students. That time also they will be paying the same money. Am I right or not? If that is the cost, now the salary payable or salary paid by the university to the teacher is a fixed cost to the university. Whether 2 students are attending or 20 students are attending or 50 students are attending, no matter. In that way, it is called fixed cost. Fixed cost is nothing but a cost which does not vary or which remains constant, irrespective of the volume of production. Irrespective of the volume of production. Now you tell me, raw material cost is a fixed cost or not? In my example, first example, to make one notebook, I need 90 sheet. Okay, 90 sheet is equal to 9 rupee, assume. I can get it in the market, 90 sheets for 9 rupees. To make one notebook, how much I'm going to spend in terms of raw material? Quickly. To make one notebook, how much I'm going to spend in terms of raw material in this example? Am I confusing you? To make one notebook, writing notebook, the manufacturer of a notebook is in need of 90 sheets. 90 page is equal to one notebook. That 90 page I can get it from the market for 9 rupees. If that is the case, how much amount the company is to spend to manufacture one notebook in terms of raw material?
9 rupees.
9 rupees. If I have to produce 100 notebooks, how much I have to spend in terms of raw material?
900.
900. Now tell me, raw material cost is a fixed cost or variable cost?
Yeah, my understanding
Variable
is
cost.
No. Your understanding, let us discuss once again. Wait. Now you tell me, raw material cost is, in my example, raw material cost is fixed cost or variable cost? To make one notebook, how much I spent?
9 rupees.
to make only one notebook. To make one notebook, I'm spending rupees 9 rupee in terms of material. At the same time, if I want to produce to make 100 notebooks, how much I have to spend?
900.
I have to spend 900. So
That's
raw
very-
material cost is an example for
Variable cost.
variable cost. It is not a fixed cost. Now you tell me, sir, what is your understanding?
No. I had the same understanding.
Okay. So raw material cost is an example for
Variable cost.
variable cost. Then what is variable cost? Any cost that varies according to the level of output. If output increases, the cost of such element is also increasing. Okay, if that is the nature, that cost is variable cost. Example for variable cost is raw material cost. All direct costs are variable cost. Okay, all indirect cost need not to be a fixed cost. It can be fixed or it can be semi-variable. Okay, let us first decide the nature of these three costs with an example. Fixed cost is a cost which remains constant irrespective of the volume of output. Another example, anybody can tell me? I told the example, salary given to the teacher by an university. If it is a hourly rate, I told you that is an example for fixed cost. Come to the manufacturing process. Any example can you give from the company point of view? Example for fixed cost. Even the production is zero, also that cost remains the same. That kind of cost is called as fixed cost.
Any lease or rental?
Yeah, rent payable by the company. Suppose you have taken a factory on a rental basis. 1 year lockdown, you are closing the factory, but you have to pay the rent. You cannot say, sir, I have taken only zero production, so please don't take. That's negotiation. That is out of some kind of humanitarian ground. But as per law, as per legality, if you produce or not producing, you have to pay rent, lease amount, lease cost. Okay, anything else? Salary payable to the manager. Manager salary. Suppose there is a lockdown. Managers are coming to you. He is ready to come. You appointed a manager. His salary is 1 lakh rupee per month. You don't produce anything. For that, he does not do anything. He is not bothered about that. He is asking his salary 1 lakh rupee. So salary payable to the manager is an example for fixed cost. Any other example? Any example for fixed cost? Insurance?
Landline,
Which one?
landline telephone connections.
Landline telephone connection is an example for fixed cost. Is it so?
Whether we use it or
How
not.
many calls you make also they will charge only 100 or 1000 or 2000? Is it not based on the number of calls what you make?
We have both the plans here.
Both the no, there is no both the plan. Unlimited, okay, maybe there is
Yeah, it's
unlimited
unlimited.
plan if you have, that is a fixed
Yeah.
cost. Suppose
Yeah.
2000 rupees every month you have to pay. Unlimited calls you make it. That 2000 rupees is an example for fixed cost.
Yes.
Okay, unlimited. Some companies are giving like that, yes. So anything like that of is called as fixed cost. Okay, so variable cost is nothing but a cost which varies according to volume of output. If volume of output increases, the total variable cost will increase. Okay, but here variable cost per unit remains constant. Variable cost per unit remains constant. What is this? You are telling just now you told variable cost will vary, but now you are telling variable cost per unit remains constant. Are you able to understand this? To produce one notebook, how much I spent in terms of paper? 9 rupee. To produce 100 notebooks, I'm spending 900 rupees in total. But here also, if you divide the 900 by 100, Per unit cost how much? Only 9 rupee. So per unit cost in terms of variable cost, per unit cost remains constant. Per unit cost remains constant. Per unit. Variable cost per unit remains constant. Look at this fixed cost. Fixed cost in total remains constant. Fixed cost in total remains constant. But at the same time, total fixed cost per unit varies. Fixed cost per unit varies. Simple example I'll tell you. Suppose assume I am getting 1000 rupees per hour to teach you. Assume just an example. 1000 rupees to teach you. If 100 students are attending, what is the cost of one student for the university? 1000 rupees is payable to the teacher. 100 students are attending the class. If that is the case, what is the class running cost per student per hour for the college?
10 rupees.
10 rupees. How did you get it?
1000 by 100.
1000 by 100. Suppose in the same university, in the same college, only 50 students are attending the class. Now, how much will be the per student cost of teaching per hour by the university?
20.
20. Now you tell me fixed cost varies according to the volume of production per unit. In the first case, it was 10 rupee. In the second case, it became 20 rupees. Assume another example. Only 10 students are attending in the class. That time, what is the cost per unit? Only 10 students are attending, yes?
100 rupees.
100 rupees. So now you can see a pattern in this. Fixed cost in total remains constant. The teacher gets 1000 rupees, even one student is attending, or even no student is attending also. If the teacher is appointed in a regular basis, he will be getting the salary. Okay, that is fixed cost. Now, come to the production. If you produce more and more units, the fixed cost per unit is coming down. 100 students, per unit cost is 10 rupee. 50 students, per unit cost is 20 rupee. Only 10 students, per unit cost is 100 rupees. So this is what we call in industry economy of large scale production, economy of scale of economy. Fixed cost remains constant irrespective of the volume of output. So the larger undertakings, larger units, they will have more number of orders to produce. So they will operate in their fullest capacity. If they operate in fullest capacity, the per unit cost in terms of fixed cost will reduce. So they will be able to sell the product for a lesser price than that of other medium-sized units or small-sized units. Okay, so this is called scale of economy. Okay, fixed cost in total remains constant. Okay, the rent paid by the company for the floor where the production is happening is 1000 rupees. 1000 units are produced in that floor. What is the rent per unit? What is the rent per unit production? 1000 rupees is the rent paid by the company for the factory. In the factory, 1000 units are produced. What is the rent per unit of production?
1 rupee.
1 rupee. Suppose there is no order, I cannot produce 1000 units. Only I am producing 200 units. Now what is the rent per unit now?
5.
5 rupees. So that 5 rupees is nothing but fixed cost of rent per unit. Okay, but even if you don't produce also, 0 units you are producing one day, Sunday closed, that day also you have to pay a rent of 1000 rupees. So fixed cost in total remains constant and fixed cost per unit varies. And varies also not indirect proportions. Higher the volume of production, lesser the fixed cost per unit. Higher the volume of production, lesser the fixed cost per unit. higher the production, lesser the fixed cost per unit. Okay, and lesser the production, higher the fixed cost per unit, vice versa. Okay, come to variable cost. Variable cost remains constant per unit. One notebook I can produce by spending 9 rupees for paper. That's it. That's constant. But in total, depending upon the number of units I'm producing, the cost of variable cost will increase. If volume of production comes down, my variable cost also will come down. Now tell me, for a manufacturer, suppose the total cost of a manufacturing, total cost is rupees 10 for producing some article. Total cost is 10. Out of this 10 rupee, 7 rupee is the fixed cost. 7 rupee is fixed cost, and only 3 rupee is variable cost. And for another company, it's opposite. 3 rupee is the variable cost, and 7 rupee. 3 rupee is the fixed cost, and 7 rupee is the variable cost. Which company is good for you, depending upon the situation? Which company is? Suppose there is a sudden reduction in the order. Which company can save themselves? Assume this is a company A and this is company B. The proportion of cost is 70% fixed for A, 30% variable for A company. For B company, out of 10 rupees of one cost of production of one unit, 3 rupees is a fixed cost and 7 rupees variable cost. Suppose there is a recession, there is a lockdown, there is a problem in the economy, order is not there. Which company is in a better position to safeguard itself?
B.
Why?
Because here variable cost, even as you said, if the production is less,
If the production is not there, it can save 70% of its cost.
yeah.
But company A is in the opposite side. That is, even though production is not there, the company has to spend 70% of its normal cost. No revenue, no production. In spite of that also, it has to spend 70% because fixed cost goes with time. Fixed cost does not go with the volume of output. It goes with time. Passage of time brings the burden for the company, for the fixed cost. But variable cost, it is not so. If you increase the volume of production, of course, the total cost of variable cost increases. That gives a mileage to you. If you increase the variable cost, that gives a mileage of sales. But fixed cost, if it is high in the proportion of total cost, that gives a burden to the company. You have to recover the fixed cost. Yeah. So this is the concept of fixed and variable cost. Next one is semi-variable cost. What is semi-variable? By this time you would have understood. Excuse me. Suddenly somebody talks. Okay, so semi-variable. Any guesses for semi-variable? It will remain constant up to certain time period. After that, it starts increasing. That's called semi-variable. Example, the normal telephone bill, up to 100 calls free. After that, per call, it will be charged by 30 paisa or 40 paisa, 50 paisa, like that. That is called semi-variable. Even electricity, up to certain number of units, fixed. You have to pay 1000 rupees per month. You can consume 100 units. After 100 units, every unit will be charged by 3 rupees or 4 rupees. If that is the case, that kind of expenditure is called as semi-variable cost. Okay, now why do we discuss this classification in marginal costing? Okay, we as a manufacturer should be in a position to understand how much I have to make sale, how much I have to sell to reach out no loss and no gain point. That is called break-even point. You might have heard about this in a colloquial term. Break-even point. What is break-even point? Break-even point is a point at which there is no gain or there is no profit. Okay, I just explained to you here. Break-even point. Break-even point is nothing but a point at which the company does not have any profit, or the company does not have any loss also. No profit and no loss. When the company will be having this position, no profit, no loss? When a company, at what stage or at what condition?
When they sell the product in the cost price.
Little louder, little louder.
When they sell the product in the cost price.
When the product is sold at the cost price. Okay, that's one point. Now we discussed about the, cost classification. No, so total cost will be equal to what? Total cost will be equal to, according to our variable and fixed. Fixed cost plus variable cost. Okay. Selling price will be equal to total cost plus
Profit.
Or can be minus loss. Total cost minus loss can be sales, or total cost plus profit can be sales. Okay. Now look at this particular statement. Income statement. Same thing, if you put it in a statement form, you can see like this. Look at this. Sales minus variable cost. We have a breakup called contribution. Excess of sales over the variable cost is called as contribution. Suppose you are selling a product for 25 lakhs. The total variable cost of that particular sales is 15,50,000. The remaining 9,50,000 we give one name. That name in accounting we call it as contribution. How much the sales have contributed to recover the fixed cost is called contribution. Or you can say excess of sales over the variable cost is called as contribution. We can write like this: sales minus variable cost. Please keep in mind, if you take total sales, then you would take total variable cost. Sometimes you may calculate sales per unit. So 1 unit is equal to 20 rupees sales, and 20 minus variable cost of 1 unit. Okay, so these both to be in same level. Sales per unit, variable cost per unit. Otherwise, sales in total like this: sales in total minus variable cost in total. Okay, is equal to contribution. Sales minus variable cost is equal to contribution. Now, if you minus your fixed cost from the contribution, we can get profit. Okay, now tell me, at the time of break-even point, at the time of break-even point, what is the relationship between fixed cost and variable fixed cost and contribution?
Both will be equal.
Both will be equal. So when contribution is exactly equal to fixed cost, that position, that condition, that situation is called as break-even point. So break-even point is a point at which the contribution of a company is exactly equal to the total fixed cost. Okay, total fixed cost. How do we find out? How do we find out the break-even point? Why do we find out a break-even point? At least I have to operate to that level so that I can manage with all my expenses without firing my finger. Okay, without taking my capital out, without eroding my capital. Okay, that's the minimum level of operation. Okay, if you operate more than the break-even point, all you are going to get profit. Okay, so how do I calculate break-even point? There are some formulas, simple formulas are there. Break-even point. So break-even point is equal to, look at this, break-even point is equal to fixed cost divided by contribution per unit. Break-even point is equal to fixed cost, total fixed cost divided by contribution per unit. How do you calculate contribution per unit? Anybody? How do you calculate contribution per unit?
Sales
What
per
is
unit.
contribution? Yeah, yes.
Per unit divided by
Sales Selling price per unit. Selling price
per
per
unit
unit minus
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 total variable cost. Variable cost per
variable cost per unit.
unit.
Variable cost per unit. That is equal to contribution per unit. With the contribution per unit, you divide the total fixed cost, you will get the break-even point. Look at this example. There's an example given to you here. Look at this. Break-even point you're going to calculate. Fixed cost is 2,50,000. Variable cost is 15 rupees per unit. Selling price is 25 rupees per unit. Okay. Comment on the level of production. That is, the company produces 12,000, 15,000, 20, 25, 30, 40. We'll come to this little later. Now, look at this. Fixed cost 2,50,000. Variable cost 15. Selling price 25. What is the contribution in this question? Contribution is equal to? Please reply. Contribution is equal to how much?
10 rupees.
10 rupees per unit.
10 rupees per unit.
10 rupees per unit. Okay. So if I want to calculate break-even point, then apply this equation. Total fixed cost. How much it is? Total fixed cost?
2,50,000.
2,50,000. Given another question. 2,50,000 divided by 10
10
rupees is equal to 25,000 units. Okay, so this will give you in units. Break-even point in units. Number of units to be sold to achieve the break-even point is total fixed cost divided by contribution per unit. No, sir, I want in rupees. What should be the selling amount? What should be the total sales volume to reach my break-even point? In that case, you just multiply these 25,000 units with selling price per unit. Can anyone tell me how much should be the break-even sales in total in this case? Break-even
25,000.
point, break-even point in rupees. Is equal to
25,000 into 25.
25,000 into
25.
what is the selling price? 25 rupees. 25,000 units into 25. This is going to be the
6 lakhs.
break-even point in rupees sales. Break-even sales in rupees. Okay, this is break-even sales in units. Okay, look at this. We have done this for all the units. They were given some units, right? If the company produces 12,000 units, what will happen? The company produces 15,000, 20,000, 25,000, 30,000, and 40,000. For that, I have done a table here. Okay. But in all the cases, in some cases there is a loss, some cases there is a profit. But at only one case, there is no profit, no loss. The profit is equal to 0. Profit is equal to 0. At what stage? That stage is nothing but 25,000 units of production. So that is called a break-even point. We already found out. Okay. Okay. Now next thing is, this can be explained in through chart also. Break-even point is a point at which the total revenue of the company, look at this, is the revenue. The total revenue of the company touches the total cost of the company. Total revenue and total cost both are meeting a same point. That point is called a break-even point. Okay. Now, if you sell more than the break-even point, that is called margin of safety. The company is safe to that much. Margin of safety. MOS, margin of safety. What is margin of safety? The excess of actual sales over the break-even sales. The excess of actual sales over the break-even sales. If my break-even sales is 90,000 units and 90,000 rupees, and my actual sales is 1,50,000. So I'm in the safe of 60,000 rupees, margin of safety. That much margin is there for me. I'm safe that much, margin of safety. I will explain again. Margin of safety is equal to actual sales in rupees or units minus break-even point of sales in units or amount. Okay. Next is very, very important. We will plan for our company, right? I want to make 1 lakh rupee profit. I want to make 2 lakh rupees profit. If that is the case, how much I have to sell? Selling price per unit remains constant. Please understand that we are not touching because that is not a controllable factor. That is uncontrollable. That may be depending upon the market. I can't just increase my selling price to increase my profit. Without increasing the selling price, by just increasing the volume of sales to earn some given amount of profit, how much I should sell. That is called sales required to earn a profit of some amount. In this case, they're asking you to find out the sales volume, number of units to be sold, or the amount of sales to be made in order to earn a profit of 60,000. In order to make a profit of 60,000. There's small equation for this under the marginal costing technique. That is fixed cost plus desired profit, or how much amount profit is required by the company, divided by PV ratio. So what is newly coming in? PV ratio. What is this? I'll explain to you what is this PV ratio. PV ratio is nothing but the contribution ratio. PV ratio means contribution ratios. C by S into 100. What is C? Contribution. What is S? Sales. So contribution divided by sales into 100 is equal to PV ratio. So if you take this PV ratio as a denominator in this equation of fixed cost plus desired profit, you will get the amount of sales to be made to earn that much of profit. Look at this example. 45,000 is the fixed cost for this company. Some data is given here. 45,000. Yes, look at this. 45,000 is fixed cost. Okay. And the company expects to have a profit of 60,000 rupees. 60,000. Okay. So 45,000 plus 60,000 profit total amount divided by PV ratio. What is PV ratio? I already told you. Contribution by sales. Okay, contribution by sales. What is contribution in this question? Variable cost in total is 75,000. Sales is 1,50,000. So what is the contribution? Contribution in total is equal to 75,000, right? 50%. 75,000 divided by 1,50,000 into 100 is equal to 50%. Are you able to get the point of PV ratio? In this case, both are 50-50. That's why little confusion. Sales also, I mean, variable cost 75,000. If variable cost 75,000, contribution is also going to be 75,000 because sales is 1,50,000. That is why contribution is taken here as 75,000 divided by 1,50,000, that is equal to 50%. So PV ratio is 50%. Fixed cost 45. Profit required is 60. So 1,05,000 divided by 0.5 is equal to 2,10,000. That is the amount of sales you have to make. If you make 2,10,000 worth of sales, you will get a profit of 60,000. So this is what variable cost, marginal cost, and you can say break-even analysis. Okay. Any doubt in this? Variable cost, fixed cost, marginal cost, break-even point, margin of safety, amount required to earn the profit of desired profit. Any doubt?
No doubt.
Yeah, no doubt. So I'll give you some 1 or 2 questions, then you can clarify a little more. Okay, I can understand whether you got the point or not. I'll just give you some data. Based on that, you just tell me. It's like a mental work you can do, or you can just work out and tell me also. I'll just give you some question from the textbook, 1 or 2 questions. Yeah. Suppose the unit of output is 5 lakh. Output. Output is 5 lakh. Output. Output is 5 lakh. Fixed cost is 7,50,000. Fixed cost is rupees 7,50,000. 7,50,000. 7,50,000 fixed cost. Variable cost per unit is rupees 2. Variable cost per unit is rupees 2. Selling price per unit. Selling price per unit is equal to selling price per unit is equal to 5 rupees. 5 rupees. Can anyone tell me the break-even point? Break-even point. What is break-even point now? Are you working on it? Please.
25,000.
20. Break-even point is 25,000 unit, or what is that?
250,000
Sorry.
unit. 250,000 units.
2 lakh.
250,000 units.
250,000 units. Okay. 2 lakh in amount.
In amount, it will be
250,000 units into
selling price per unit.
how
5
much?
rupees. 12,50,000.
Sorry, 12,50,000.
Yes.
Yeah. So how did you calculate in units? Break-even point in unit is equal to
Fixed cost 7,50,000 divided by
fixed cost divided by
contribution,
contribution.
which is selling price per unit minus variable.
Contribution per unit.
Yeah.
That is equal to fixed cost how much? 7,50,000
Yeah. 7,50,000
divided by
5 minus 2.
5 minus 2. 5 minus 2. That is 3. 5 minus 2. That is 3. So 7,50,000 divided by 3. That is equal to
250,000 units. 250,000 units.
250,000 units. Okay. In terms of rupees, if you want to calculate fixed cost divided by PV ratio. Fixed cost divided by PV ratio. So fixed cost, that is 7,50,000 divided by PV ratio. What is PV ratio? PV ratio is nothing but
Contribution by sales.
contribution by sales into 100. So 3 by 5. What is 3 by 5? 3 by 5. 3 by 5. What is the answer for this?
12,50,000.
12,50,000. This is rupees, this is units.
Yeah, instead of using this formula, we can directly
Yes,
multiply.
yes, you can do whatever the way in which, but you can find out the answer correctly. That's it. You can multiply 2,50,000 units into 5.
Yeah.
That's also okay. Yeah. Okay, then question number 2. The sales needed for a profit of 6 lakhs. Sales needed for the profit of rupees 6 lakhs. I want to earn a profit of 6 lakhs. If that is the case, how much rupee I have to make a sales? How will you calculate this? Sales is equal to
Fixed cost.
fixed cost plus desired profit or profit needed. Profit needed. Okay. Profit intended. Profit needed. Whole thing divided by
PV ratio.
PV ratio. PV ratio already we calculated 3 by 5. What is the answer now then? Fixed cost is 7,50,000. 7,50,000 plus 6 lakhs. 13,50,000. 13,50,000 divided by 3 by 5. Is equal to
22 lakhs 50,000.
22 lakhs 50,000. That is the amount to be made as sales in order to earn a profit of 6 lakhs.
6 lakhs.
Okay. One more question. If the profit if 4 lakh units are sold at rupees 4 per unit, what is the profit? What is the profit? If 4 lakh units are sold, sales is equal to 4 lakh unit. 4 lakh units at the rate of rupees 6 per unit. If I sell 1 unit at the rate of 6 rupee and I sell 4 lakh unit, what is the profit? What is the profit? Sales is equal to how much? 4 lakhs into 6 rupee. 4 lakh into 6 rupees is equal to
24 lakhs.
24 lakhs will be my sales minus variable cost. How much variable cost?
2 lakh per unit.
What is variable cost given the question?
2 per unit. Rupees 2
2 per unit. So how much will be variable cost now? How much?
8 lakhs.
8 lakh. 8 lakh will be my variable cost. If I minus variable cost from sales, what I will get? Contribution. The contribution is equal to 16 lakhs. What is the fixed cost now? Fixed cost how much?
7.5 lakhs.
7.5 lakhs. That remains constant. So 7.5 lakhs. So profit will be equal to is equal to 8,50,000.
8 lakh.
Now you want to calculate the profit of a company. This is called a statement of profit. Statement of profit. Sales minus variable cost is equal to contribution. That minus fixed cost, that is equal to profit. Okay, so this is what we thought of doing it today under marginal costing. Look at this statement. Sales minus variable cost is equal to contribution. Contribution minus fixed cost is equal to profit. This is what we call it as statement of profit, income statement under costing. Okay. I hope this is easy to understand. Variable cost, fixed cost, and marginal cost.
Yes, Professor.
Yeah. So this about the syllabus. Okay, totally. We have completed it now. The cost sheet, I think that is not done by us. I mean, in a screen like this, but the explanation for the detailed content is already given. So you have to just write the amount wherever possible. You have to write the amount. There are some questions given in the LMS. You can just go through that with answer. Cost accounting or cost sheet. Any other doubt with regard to the entire aspect from the first class to now? This is the last class. I think we are not going to meet again. After this, you are going to write directly the exam. So if you have any doubt, any questions, any concern, you have to raise it now.
Sir, if you can provide us like the main topics which we can.
Yeah, main topics. Okay. Main topic. Yeah. Financial statement, ratio analysis, cash flow statement. These are all very, very important. And of course, you have 100-mark question. So all topics will be covered. Your question paper is about 100 marks. 100 marks without choice. If with the choice means, of course, there are another 20-25 marks added. So all the chapters will be there in the exam question paper. But to be more specific, of course, final accounts, financial statement, that is income statement and the balance sheet. That is very, very important. All other aspects also important only, because 100 mark plus 20, 120 mark, if anybody sets a question paper, almost all the topics will be covered in that. Trial balance, preparation of trial balance, and then preparation of cash flow statement, preparation of financial statement, that is income statement and the balance sheet, ratio analysis, cost sheet, and marginal costing. Of course, all these chapters are having a numerical. And in exam, numerical maybe sometime I will give you some number and ask you to calculate. Otherwise, I will tell you to assume some number. I mean, you only have to make the question also and answer also. For example, I will be asking you, what do you understand by cash flow statement? Illustrate a cash flow statement with hypothetical figure. That time, you don't have any numbers in the question paper to prepare a cash flow statement. Somebody may feel it is very easy to do without number because you can take your own. But somebody may feel difficult, so nothing is there, how can I make a cash flow statement? But there may be a chance to ask you, illustrate a cash flow statement on your own hypothetical figures. That time you should be remembering the cash flow statement format. As far as possible, you have to give some information about the each and every item, and you have to construct a cash flow statement. Similar case is for trial balance as well. Sometime I will be giving you some 20 items. Without debit credit, I will be giving you the summary of ledger accounts, and you may be asked to prepare a trial balance. Okay, out of the 20 items, you'll be taking all the debit items and writing in debit side of the trial balance, and those of credit, you will write in credit side of the trial balance, and you have to tally the trial balance and give it. That's one thing. Other way around is, I may tell you to explain what is the trial balance and give an example for a trial balance, illustrate a trial balance. That time, you only have to take some values, you only have to take some items depending upon the debit credit, and you have to make a trial balance. I hope it is understandable, right? Sometime there will be a detailed question with the number, data. Sometime you may be asked to explain the concept of a particular thing, and you will be asked to illustrate that. Got it?
Professor, in last
Yeah,
class,
so that
there
is the
was,
case. Yes.
last
Louder.
in the last class, cash flow statement. Okay, there was a term called GR. Okay, transfer to GR. Like, what does the GR stands for? Any idea?
General reserve. General reserve.
Generally, so I mean, that was not given in the question, but still we have.
It was
somehow
given. It was given. Where it was not given?
general.
General reserve in 1 year some amount was there, and another year some amount was there, right?
Okay, and
The
purchase
difference
of the.
between 1 second. The difference between that two is the value what you have to take for the current year. Suppose last
Okay.
year the general reserve was 5 lakhs. Current year the general reserve in the balance sheet is 6 lakhs. What does it mean? Last year closing balance was 5 lakh. current year closing balance is 6 lakhs, which means that in the current year profit, you have taken 1 lakh rupee and you transferred that 1 lakh rupee to general reserve. So without you transfer that 1 lakh, your profit would have been higher. That is why that 1 lakh has been added in the profit and loss account to find out the cash flow from operating activity. You can see that statement. 1 lakh I might have taken in cash flow from operating activity added. The same 1 lakh I would have written in the general reserve 1 lakh rupee minus. So that is why it is taken there. GR means general reserve. It is not given directly in the question down the answer, I mean adjustment or something in the balance sheet itself. Say for example, share capital was 5 lakh, now it is 6 lakhs. The difference 1 lakh you are taking to cash flow from financing activity 1 lakh, no, similar way.
The purchase, and there was one confusion with the purchase.
Louder.
There was one confusion with purchase of machinery as well, Professor.
Purchase of machinery, you are making a machinery account. If you have all the entries are done, okay, still you don't have the both side tallying. That time, if there is any shortage in the left side, that should be considered as purchase of machine, cash outflow of investment activity. If there is any shortage in the credit side of the machinery account, that need to be considered as sale of machine. That should be recorded in the cash flow statement in the inflow of cash in the investment activity. Purchase of machine, sale of machine should be identified by preparing a machinery account. Machinery opening balance and closing balance will be there in the balance sheet. Last year figure is the opening balance. I'm sorry, current year figure is the closing balance. In between, there might have been some sales, purchase, depreciation, etc. That will be given in the question. After doing all those entries in the machine account, both side total should be same. Suppose if it is not the same, there is a shortage. Say for example, credit side 1 lakh is there, the total. Debit side total is only 80,000. So 20,000 short in debit side. That means we have purchased a machine for 20,000 rupees. That 20,000 you put it in debit side of the machine account and close it. And the same 20,000 you bring it to cash flow statement under investment activity under outflow. Okay, if it is other way around, the credit side is short and debit side is more, then you write sales, by sales. That much amount will come under investment activity as cash inflows. Sale of machine 20,000. That's it. You're getting my point?
Sir, I have a question.
Yes.
In the part B, like 10 marks questions,
In part
there
B,
are
10 marker. Yes.
yes. So there are based on the previous year question papers, I saw
5
there are
questions
a lot
are
of
there.
numericals are there. So
Okay.
in evaluation, only the final answer carries the marks, or the steps will carry the marks. Like if we
Both.
miss,
Both are carrying the mark. Steps are having mark. That's it.
Okay. Thank you, sir.
Any other question? So your question pattern, you know, right? Section A, 3 into 5, 15 marks. Section B, 4 into 5, 45 marks. Sorry, 4 into 5, 4 into 10, 40 marks. 4 into 10, 40 marks. Section C, 3 into 15, 45 marks. 15 plus 40 plus 45, totally 100 marks. Section C, no option, no choices. Section A and B, you have choices. Write all the questions. Okay, all the question means not without a choice. With choice, write all the questions for 100 marks. and prepare well. And there is chance of failing also because it's a numerical paper. Of course, step marks are there, but if you did not do any step, we cannot give any mark. Okay. Some people will do same. They will write the question paper again. Don't do all those kind of tricks. You study well, and reasonably question paper will be easy. Okay, those who are little bit knowing the concept, it will be easy, but not that tough. Without final accounts, don't go to the exam without final accounts preparation. Okay. Any other specific doubt? Assignment 2, all of you submitted because 30th they told tomorrow is the last date they're going to close the LMS. But we have given some date before, after that, but that is not working out. So please submit it by tomorrow. Tomorrow, day after tomorrow, 30th, 31st, check it in the LMS. Within that time period, you submit it.
What is final accounts? That have balance statement and income and
Final
profit.
accounts. Okay, final account means financial statement of the company.
Okay, okay.
Financial statement of a company.
So
So
for
do we
both the assignments you'll be doing the grading today, sir? Today or tomorrow?
Yes, that is my deadline. No, we have to give. Yes, I'll give you. Yes.
Yeah.
So
Don't
do
worry,
we have
assignments? Yeah, will be graded. Yes, yeah.
so do we have theory and numerical both? In
Yes,
our-
both will be there. Yes.
Okay. And what is the minimum passing marks out of 100?
50%, no, 50%.
50. That,
All PGs 50%, no?
that is excluding assignment marks or?
No, out of 100, percentage means what? You can include also 50 only, you can exclude also 50 percentage. Out of 100, you should get 50.
No, what we meant is like 60 marks is for assignments and
Hmm.
100 marks we are writing for theory.
No, you are
I mean,
writing 100. Out of that 100, you have to get 50%.
Okay.
Otherwise, out of 60, you might have already got 50. Then 0 also, if you get in final exam, you will be passed, not like that.
Yeah. That's what. Yeah.
That is not
So-
there. Actually, I think I'm not sure about it. Normally 50%, but in our university, in exam, if you get out of 140 also, put together, total is 50%, I think you are passed. Let me check it in the university. But better, to the safer side, always PG, in any exam or any test, you have to cross 50%. Suppose in the final exam, out of 100, you got 40. In the assignment, out of 60, you got 25. So 25 plus 40, 25 plus this is converted into 40, no? So if it is put together more than 50%, you are passed. Okay, but don't confuse 50%, you get it in the exam to be in the safer side. But getting 50 is okay, normal, easy. Unless otherwise you don't write the exam, you don't write any answer like that. And specific to the point, you write it. Don't write anything irrelevant. They are asking you what is trial balance, please write about trial balance. Exam, they told you it's online or offline?
Online.
Online only.
Yeah.
Okay.
So you are going to set the question paper, sir, or someone else?
Question paper, whoever sets also, that should be coming from this area. No, actually we only should set the question paper.
Yeah.
Yes, already set and sent. And they have a lot of questions with them. They will ask so many question paper. 4 question papers they'll ask every year. So they will mountaining the question paper with the office. Any one question paper randomly they take and give it. But whatever it is, whoever sets the question paper, whenever they set the question paper, concept remains the concepts. If you know it, you can write it, that's all. One financial statement, ratio analysis, cash flow, then this trial balance, marginal costing, just what we discussed, cost sheet. Any 4 concept, if you know 4 into 10, 10 mark. But of course, if you're writing all correct. Okay, any specific doubt? Pattern of examination, questions, and then syllabus, or any specific concept? Long back we discussed theoretical aspect now in the regular class, I mean offline class. That also to be studied. Concept of account, concepts and conventions of accounting, IFRS, IND-AS, all these things. Okay. All are direct question, not like that much indirect question and all. Mostly will be direct questions. Okay, if you don't have anything to ask,
The calculator,
yes, sir.
scientific calculators are allowed, Professor.
Scientific calculator allowed or not? See, there is no need of using any scientific calculator. And one more thing, you are having online exam only. So nobody is going to bother which calculator you are going to use. Preferably normal calculator use it, that's all. Only for plus minus only now. Or in the system itself we can calculate. System calculator will be there, no?
Some of us, we will use mobile.
Is it a proctored exam? Are they going to proctor you?
Yeah, proctor in sense, invigilators will be watching us.
Through Google Classroom. I mean, Google Meet.
Through Zoom Meet.
Zoom Meet only. Okay.
Yes. And they will have a frequent.
No problem. We can use a calculator, but mobile calculator, I'm not sure. That is, you can avoid.
Yeah.
Scientific calculator, okay. There's nothing, unless otherwise it's a programmable calculator, it is okay. But that much minute level, they won't check it because it's offline exam, online exam. And there is nothing to have any formula for this kind of subject, right? In the statistics, there may be some lot of formulas. So calculator is allowed.
Okay.
Yes. Any other doubt? If not, all the very best for your exam. Thank you so much for joining the session in the extra class, and also all the best for your exam once again. Thank you. At any point in time, if you have any doubt before the exam, not during the exam, before the exam, you can call me or you can WhatsApp me as usual. You can get the doubts clarified. Okay.
Okay, sir.
Okay.
Thank you, sir.
Thank you so much.
Thank you, sir.
Thank you,
all.
Professor.
All the best.
Bye bye.
Yeah, Professor.
Yeah, thank you.
Thank you, Professor.
Thank you.
Thank you, sir.
Thank you.